All right, so this is the question almost, probably 80–90% of the class gets right because it's just plugging numbers into formulas, and the first formula you already know. So it's pretty straightforward, very straightforward question. And I'll make it easier for me because I give you the discount rates. So you might have got a different discount rate in question 1, but if I give everybody the same discount rate, more people get the right answer, so it makes it faster for me to grade. But just the formulas, dividend discount model, very simple. Dividend 0 times 1 plus long-term growth divided by KE minus long-term growth. Very simple. And then cap earnings model. Is, I don't know why I have plus on there, is earnings per share. Wow. Times inflation. So it looks almost exactly the same. You just use earnings instead of dividends. You use inflation in lieu of growth. And then the H model, very simple. Again, looks exactly like the dividend discount model. In team 4, I think your issue might have been a parentheses issue, but we'll see. Let's dividend 0 times H times short-term growth minus long-term growth. And all of that divided by that. So they're very, very similar formulas. Now, on the dividend discount model, the one answer I see the most, well, team 4 and 5 got this answer, so I'm gonna assume it's probably right. The 2 teams they got 114.45. So that would be 3.27 times 1.05 divided by 0.08 minus 0.05. Does that work? 327. 114.45 looks pretty close. All right. Cap earnings, they both got 101.38. So that's going to be 5.44 times 1.025 divided by 0.08 minus 0.025. See if that works. $101.38, is that what I said? 101.38, so that works. And then now team 4, the reason I question your answer is your H model is a lower number than your dividend discount model. When can the H model be lower than dividend discount model? Only if your short-term growth is lower than your long-term growth, which is not the case here. So y'all had something happen there. Y'all's number looks awfully high to me, but we'll see. So let's try it. What was the H here? 5, because they said over 10 years, so you take half of that. And I can't possibly remember all of that, so. Wait, what did I do? Oh, I copied too much, didn't I? All right. All right, that looks better. So So plus 3.27 times 1.05 plus 3.27 times 5 times 0.1 divided by 0.03. I get that. Did y'all get that? That looks lower than your number, doesn't it? How can we check it? Well, we'll take the first part of the formula out. 54 plus 114.45 plus that 168.95 looks right. What did y'all get? 180. Yeah, that seemed high to me. So did anybody get that last one? Did y'all? Y'all did? Ah, team 3. All right, good. 168.95. All right, so yeah, there it is. Just plugging numbers in the formulas. If you show your work, it's possible to have a math error. But I do count off. Let's say, I mean, you have your problem written exactly right, but you got the wrong answer. Normally, I give you full credit, except for you have to know that it can't be lower than your dividend discount model. So when you see that, I say you can write a note, say I ran out of time. I know this can't be lower, and I'll probably give you almost full credit for that. But so double check this, because it's going to be just that part of the equation is going to be what's adding to your dividend discount model. All right, good. Okay, so let's talk options. So last week we talked options are a right to do something, right to buy something, that's called a call. A right to sell something is called a put. At some future date that's stated in the option. You don't have choices on that. You have to use the option expiration dates, and at some stated price, again, you don't have any choice on that. They just have a list of them. Anybody know what all these combinations of dates and prices is called? Anybody's heard that term before? It's called the option chain. Does that sound familiar? Option chain. So we talked last week, does the right to buy something have value even if the call price is higher than the current stock price? And it does, because in the future, the stock could go above that amount. So last time we started on this Texas video, TXSVID. It's a good thing to remember. I used to ask this question on the exam, but it's so easy. Everybody's getting it right. So it's like wasting my time grading it. And, it's kind of free points for you, but you don't really need them. You can get everything else right. So, so the X is strike RK, depending on how you think of the word strike. So if you're a bowler, use X. If you're a baseball, use a K. So the X is the strike price, the right you have to buy something or sell something, whether it's a call or a put. Now, what does the strike price have to do with the value of the option? Well, a call option, the higher the strike price, the less valuable the option is, because that's your right to buy it. If you have to buy it at a higher price, that's going to be less valuable to you. So higher strike prices, higher strike prices, lower option prices, call option prices. Sorry, and try to. So let's look at oh, I don't know. I was looking at Zoom earlier. Let's look at Zoom. So Zoom has a stock price right at $77. So we'll go over to the options. Go out a couple of months. Let's go out to March. So this is the option chain. The option chain shows you, well, actually, this isn't the full option chain. The option chain would be at all of these dates. So you can see there's just hundreds and hundreds of options for each company. So I'm doing March. This is the option change for March. Here's the strike prices. You notice as the strike price on the call, these are calls. As the strike price on calls falls, the option price goes up. So lower strike, higher option price, higher strike, lower option price. So it's trading for $77, but here's a option for $130 and it's going for 56 cents. Not very likely Zoom's going to shoot up to 130, but if you go back a few years, they were at $460. So could a stock that just a couple of years ago was at 460, could it go to over 130? How long did it take it to get from here? It went from 70 bucks to 460 in 3 months. So could it do that again? Yeah, we have another pandemic and everybody's on Zoom again. I guess it's possible. Right? On puts, the exact opposite. The higher the strike on the put, because that's what you get to sell it for, the more valuable the put. So higher put prices, higher the value of the option. You can see that down below where we have the puts. As the strike goes up, the put value goes up. So $130, do you have the right to sell something for $130? Is only trading for $77. You'd have to pay $54 for that. It's almost not even worth it. So the higher the strike, the more valuable the put. The lower the strike, the more valuable the call. They go in opposite directions. That's not true for all of these. So don't get in the habit of thinking calls and puts go in opposite directions. Sometimes they go in the same direction. So, all right, that's the strike. So how do you pick your strike? Well, it depends on how confident you are and how much money you want to spend. So if you keep raising your call option to higher and higher and higher, yeah, you get a cheaper call, but the chances of your stock going above that is going to be so low that you're just throwing money away. If you say, hey, it's trading for 77, I want a strike of 80, yeah, you're going to have a good chance of hitting 80 and getting a lot of money, but it's going to cost you a lot to do that. So you have to balance those two. All right, so that's the X. The second thing is time. So time is the maturity. I showed you on March option, but there's November, December, January. There's several. Well, you can even see. Oh, I'm so sick and tired of Zoom. Let me get out. So you can see for here, they go all the way out to January 2025. That's a very long option out. And so let's look at $100 call option is $3.25. If it's a March, what do you think happens if I go out in time? Does that increase the value of the option? Do you want to buy the stock for whatever it's at, 100 bucks? You have a better chance of making money if your option expires in March or if it expires in January 2025. More time, more value. So here we look at a $100 option and look at that. It's $19. So it's 6 times more expensive. So more time is going to cost you a whole lot more. So you can save money on options if you have a shorter horizon. You only go out 2 or 3 months, but then your chances of making money is going to be much less because you don't have enough. Same thing. It's the exact same thing with puts. This $60 put was $13.40 when we go out that far, out to January. If we just go out to March, that's $60 is only $3.75. So for puts and calls, time has the exact same impact. More time, more valuable the option. So more time increases the value of the option. But here we got to figure out something. I think about 50% of students get this right on the exam. This concept of time decay and time value. So we'll get into it more when we talk about intrinsic value. But intrinsic value is what the option is worth if you were to exercise it today. So here you have an option that, remember, this is a 77. Wow, they went up to 77 bucks. So they've gone up like 20 cents since we've been started talking here. Here's an option to buy that stock for 90 bucks. Would you execute that today? Would you buy a stock for 90 bucks today that you could buy for 77 bucks? No, it's worthless. The intrinsic value is 0. This is called out of the money. It's out of the money. You will not execute this today. It doesn't mean it's valueless. You're paying $5.75. It just means the true value today is zero. It means the intrinsic value. If on a call, if the strike price is higher than the current price, it's out of the money. It has no intrinsic value, which means this entire 575 is 100% time value. Okay. Now let's look here, 70 bucks. Would you execute that option today? You could buy the stock for 70 bucks and it's trading for 77. You would. How much is this intrinsic value? $7. Pretty straightforward. 77 you can buy for 70, so 7. So intrinsic value is $7, but the options $14.75. So $7 intrinsic value, $7.75. That's time value. Okay, so you split it. The option premium, this $14.75, is split between intrinsic value, which here is $7, and time value, which is $7.75. Or here, the intrinsic value is 0 and the time value is $7.45. So it's 100% time. Now, what time says is as we get closer to expiration, the time value is going to approach 0. It's going to get close because once you get the expiration, it's going to trade for its intrinsic value. I mean, if this thing expires today, do you think it's going to be trading for $5.75? It would be worthless. Wouldn't even be a penny. You know, well, the market has 4 minutes left. What's the chance Zoom's going to hit 90 bucks in the next four minutes? Pretty unlikely. I mean, it could, but pretty unlikely. You probably wouldn't even pay a penny for that. So it's 100% time value, and that time value is just going to decline to nothing at the end. So that's time value. Time value is very, very important because you have to manage time value. Because time value is very expensive and you lose it over time. Just by the passage of time, time value comes down. So you're losing something. So you got to manage it very, very carefully. But one thing about time value is it doesn't decline at a constant pace. It declines very slowly until the last 30 days, and then it drops dramatically, which means you want to do some trades those last 30 days so you capture as much of that time value as you can. I learned that a lot at USA. The option trades we did, I started getting a lot better at what was the best point to do some trades so I can recapture as much time value as I could. So that's what time decay is. Time decay is the concept that time value is going to decline until expiration, and expiration is 0. It's going to be 100% intrinsic value. We're going to see this more when we actually do the math. All right, so the strike price for call options higher gives you a lower price. Put options higher gives you a higher price. For time, more time increases the value of all options. So now let's flip over to the stock price. That's $77 for Zoom. The stock price goes in the exact same direction, the exact opposite direction as the strike. A higher stock price increases the value of the option, call option. A higher stock price reduces the value of a put option. And that makes sense. You got a strike of 80 bucks and the stock goes up from 70 bucks to $79, it's going to be more valuable because you're much more likely for that stock to go above your strike. For a put, since what you have to sell it by, if the stock price goes up, you could have sold it at a much, much higher price. So that strike versus the stock price is going to hurt you, so the stock goes down. And we can see that, well, we actually can't see it on the screen. I wish I could have shown you. This keeps going up in price, 7, 70, 20. So these premiums on the call side are probably going up a few pennies, and on the put side, they're probably falling a few pennies out. The stock goes up and down. I can't actually demonstrate that to you because I can't cause the stock price to go up and down. The next one, maybe the most important one, is volatility. The V of VID. Volatility, just like time, higher volatility, more valuable the option. Doesn't matter if it's a call or a put. So for time and volatility, more volatility, the more valuable the option. This is where options are very different than any other assets. All other assets, if they're more risky, their value goes down. But with options, if there's more volatility, their value goes up. It's a very different way of thinking about the world. I actually think the world of investing is broken into two types of assets. The normal assets like stocks and bonds and real estate, they're priced based on dividend discount models and discounted cash flow models. That makes sense. Higher risk reduces the value. And then there's the option world, where they're not value using discounted cash flow models, they're value using option pricing models where volatility increases their value. They're very, very different animals. So the higher the volatility, the more valuable an option is. Doesn't matter if it's a call or a put. Of all of these inputs, TXS, VID, volatility is the only one we don't really know when we buy the option. We know the stock price when we buy the option. We know the time, the maturity. We know this. We know the strike price. We know everything except for the volatility. This is not the volatility of the stock in the past. This is the volatility of the stock expected during the time you have the option. So it's known as implied volatility. If you've ever heard that term before. Have y'all heard of the VIX? Does that sound familiar? There's the VIX. Wow, it's back up to above. Rising up a little bit last few days. So the VIX is the implied volatility of an option on the S&P 500. So essentially the VIX is saying the annual standard deviation of the S&P 500 is expected to be 21.36% over the next 3 months. The implied volatility. You can see it's off of CBOE options. Now, this is where my mind can't function very well. You can actually buy options on the VIX. So that means VIX, which is the implied volatility, the VIX has an implied volatility. Isn't that just crazy, right? We're getting a little bit crazy here in this. So the strike is as low as 10, which is a pretty ridiculous one. And then look, it was up to 100. Now 100 should be impossible. It should be impossible for the S&P to have 100% standard deviation, because what's the most you can lose on the S&P 500? Put money into it, you can lose 100%. So 100% standard deviation implies. But this is not the standard deviation over next year. It's the annualized standard deviation over the next 3 months. So when you annualize it, you can get 100%, even though the actual standard deviation can't be 100%. You can't lose, 100% standard deviation means a 1 sigma event, you can lose more than 100% of your money. That doesn't make sense. So, but you can get that for 2 cents. Pretty cheap. 30. Boy, they're all pretty. Oh, this is April. It's out there. Yeah, those look like really cheap options. I've never done an option on the VIX. I should do it just so I can talk about it at a party sometime and talk about it like it's a normal thing. Yeah, my VIX options in there. Yeah, it just seems like a really bizarre world. And since this is the one unknown, it really is the one you're somewhat betting on. Because if you think it's too high or too low, that's really where you have some decision on whether you think the option's mispriced. Usually when we buy options, we're looking at the underlying and seeing if it's mispriced. But here, if you're wondering if the option's mispriced, you look at the implied volatility. So very different in CAPM, where more risk reduces the value of things. Here, more risk increases the value of the option. Interest rates are not that critical, but especially right now, interest rates are still relatively low. They're not as low as they were, but they're still relatively low. But it's the same thing we saw with futures. When you have options, you have the right to buy a stock in the future at some price, which means you don't have to buy it today, which means you save the money today. So essentially buying the call option is saving you interest, because you don't, if you bought the stock today, 77 bucks, you're out 77 bucks. You can't make anything on that 77 bucks. Instead, if you buy the call option, you save that money. And so that's all it's doing. It's just time value money. Very, very straightforward kind of stuff. And higher interest rates increase the value of call options and decrease the value of put options. But that's only because with put options, you could have sold the stock today. Instead, you're going to delay it for a few months. Call options, you could have bought it today. Instead, options you're going to delay it. And then dividends, we'll just ignore, but When a stock pays a dividend, remember when it goes ex-dividend, the stock price falls. That's good for puts, bad for calls. So you have to adjust for that in the formula. So let's look at the formula. What formula am I talking about? Do y'all know? Have y'all heard of Black-Scholes? That sound familiar, Black-Scholes? I don't know which of those two. Are still alive. They may both be around. Orange Scholes. I don't know if it tells us if he's alive or not. You see Merton in there. Merton didn't get his name onto the formula. Poor guy. He's famous for a lot of other stuff. So Fisher Black. I don't know if they won Nobel Prizes for this. I don't think they did. Oh, he's passed away. Oh, a long time ago, didn't he? Wow, he died. Trust me, that's young. I don't think it is, but 57 is very, very young. And then Myron Scholes. He looks alive there. He's 81. He's getting up there. And there it is in the third paragraph, Black-Scholes. So that's what he's famous for. He's famous for other things as well, but that's certainly the one he's most famous for. So here's the formula. It's actually a fairly simple formula. It's one you could set up in Excel very, very easily. So let's look at it. So there's S. Oops. I don't know what I just clicked on. I didn't mean to. There's S. What does S stand for? Underlying stock price. K, what is K? Strike price. So they're baseball players and not bowlers, so they use K. What do you think R is for? The risk-free rate. Sigma. That's volatility. Sigma squared is volatility. T, any guesses on T? Time, right? Time. And so these N's and D's, the D's is this formula. What's the N? Y'all know how to do N? The normal table in Excel. Norm dist in Excel. You probably use that in your stats class. So pretty interesting. What's the N of D telling you? The N of D, I mean, this is how simple this formula is. You remember using norm table to get probability. You want to know what's the probability of being 2 standard deviations away, 3 standard deviations. That's all this thing is doing. And it's a really simple formula, isn't it? They're looking at the stock price, the strike price, the time, interest rates, and they're trying to figure out what's the probability the stock's going to be above that strike price, looking at its standard deviation. And it's just looking at the number of standard deviations. I mean, that's a formula you could have come up with in your stats class. This is not I mean, it looks complicated looking at it, but it's really not that complicated. So you could certainly handle it. I don't have the formula memorized anymore. I had it memorized on the CFA exam, but I couldn't do it. But the underlying concept's not too difficult. So that's a call option. You can see all the things that we just saw, text videos all in there. The one thing that's missing is what? What's not in the formula of Texas videos? The T's in there, X is in there, S is in there, V is in there, I is in there. Dividends. So Black-Scholes forgot to adjust for dividends. So you have new formulas that do the dividends now. So there's the call option. Wikipedia is a bit better source. So the call option and put option have different formulas, but all the same inputs. So it's very easy. You might even try this to set this up in Excel, because it's not that hard of a formula, and see if you can match the answers. So how do you match the answers? Well, if you go to CBOE, they actually have the option calculator under education. And you can put all those, well, not there, but you can put all those inputs in there. The date, the strike price, expiration date, volatility, all those kind of things you can put in there. Or you can put everything you know, including the option price, and it'll tell you what the implied volatility is. That's how most people use these models. So you could actually set up an option in cboe.com and then set up the formula in Excel and see if you can match their numbers. You can't do the dividends, so you have to keep dividends at 0. I don't think Zoom's paying dividends, so you could probably come back into their numbers. So you can't do that. I had to set up this formula at UTSA because we were hiring people who came from public companies and they had stock options. And we had to try to figure out the value of their stock options. But they weren't traded stock options because they were essentially employee stock options. I couldn't go out and look them up anywhere. So we had to use Black-Scholes to calculate it. So it was, I think it took me 10 minutes to set up in Excel because it's a pretty easy formula to handle. All right, so there's the inputs, TXS, VID. We use Greek letters to try to figure out how sensitive the option is to different things. So delta, gamma, theta, vega, and rho are the ones that we use. Delta is the easiest one. So essentially what they say is how much will the option price change given the underlying change? So how much will Zoom options change when Zoom's price changes? That's the delta. So delta 60% means, hey, if the underlying goes up 10%, the option price is going to go up 6%. That's delta. Delta is very, very important because it tells you, how levered you are. Gamma is the one I used to forget all the time, and then it would come back and bite me. Gamma is the change in the delta. So as the underlying changes, so delta is not this straight line. It's a lot like convexity. It doesn't go move in a straight line. So gamma, and it depends on the option, the strategy you're doing. Sometimes gamma can kill you. I've learned really, really important lesson that gamma should be one of the first things you look at. I almost thought it was more important than delta. We'll talk about when we do covered call or no collars, where gamma is extremely important for collars. Theta is pretty easy because it starts with a T. So think of theta for time. So theta is how's the option price going to change just because you move one more day into time. That's that time decay. Will it fall 2%? So like I said, when you're far away, it doesn't move down very much. The last 30 days, theta increases a bunch. It gets really pretty high and pretty dangerous. Vega is pretty good because it starts with a V. So what do you think Vega is? The option price changes when the underlying volatility changes. So they kind of helped us out there with theta and vega. Theta for time, vega for volatility. And then rho starts with an R. So that's how much, think rates, interest rates. How much does the option price change given changes in interest rates? That one probably has the least impact. Mainly because most of these options are, are 3-6 months out. Time value money on the risk-free rate is not that big of a number. Now, I can't calculate all these things, but if you use the Bloomberg machine, Bloomberg will calculate all these numbers for you. When I did option trading at USA, my trader, I used Credit Suisse, a guy named Stu, really brilliant guy. He would send me my Greeks on a daily basis so I could just see. He would calculate them all. And I trusted his numbers more than Bloomberg, so he would give me some good insights. And he would actually calculate it himself. He had the statistics behind it. So if you become an option trader, you're going to become very knowledgeable of these numbers. And you'll get to the point where no one can talk to you anymore because you're going to be it's going to sound like you're literally speaking Greek because you're going to be talking these things like these are normal things. I never got quite to that point, to be sure, because I wasn't trading these things every day. I was trading, a few a month. But yeah, you get to the point where you just, not only do you know these really well, but you get to the point where your intuition's really good. You see the stock price change, you know exactly what your options did. You just become so astute to how these things move. So there is some intuition to these I don't know, calculations. Questions on that? Have you heard the Greeks before? Delta, gamma. If you want to be an option trader, this is the stuff you got to learn and get really, really good at, and then find a job where you just in this every single day. All right, so we're already talking about this. Options can be in the money, out of the money, at the money. So let's practice and see how good you're getting at this. I'm going to give you some examples. I'm going to guess that you won't do very well, but we'll see. I guess because of prior classes, but we'll see. Let's say the stock price 100. Let's say the call option premium is 135. I'm sorry, call option strike. The call option premium is 435. First question, is this call option in the money, at the money, or out of the money? Out of the money, all right. So what is its intrinsic value? So every option that is out of the money has an intrinsic value of what? It's always the same number, so that makes it easy. It's always zero. Yeah, if you're out of the money, it's always zero. So if your intrinsic value is zero, what's your time value? Well, for all stocks that have zero intrinsic value, the time value is always what? The option price, 435. All right, what's that 435 going to do just because time passes? It's smaller and smaller and smaller. It's going to decay over time. All right. Let's do stock price is 50. Put option strike is 60. Put option premium is 13. All right, so is this out of the money or in the money? I'm hearing like, money, money. That's what I'm hearing. Say it boldly. In the money. So how do we know it's in the money? Well, if a stock's trading for $100, would you execute an option to buy it for 135? Absolutely not. If a stock's trading for $50, would you execute an option to sell it for 60? Absolutely. That's how you know it's in the out of the money. All right. So what is the intrinsic value? What would you gain if you executed this option? $10. I'll see that you could buy the stock for $50 in the market and execute your option to sell it for $60. You make $10 just like that. So what's the time value then? Remember, the option premium equals the intrinsic value plus the time value. So what's the time value? $3. It's on the exam, you're gonna have to tell me what the time value is. And I'm not gonna ask you the intrinsic value because you're gonna calculate that kind of part of the problem. So that $3 is going to decline to zero over time, but that's the starting time value of the option. And we could flip it the other way around and, They're just the opposite direction. So calls prefer higher underlying prices. They want this $100 go up. Puts like the lower underlying, they want this price to go down. But the mechanics work the same. So current price is greater than the strike price for a call that's in the money, so it has intrinsic value. If the current price is greater than the strike price for a put, it's out of the money, it has no intrinsic value. If the strike price is greater than the current price for a call, the strike price is greater than the current price. So I flipped them. Strike price is greater than current, and it's out of the money. What I just did there, 135 versus 100. So it's 100% time value. The strike price is greater than the current price. It's in the money. That's what I just did, 60 versus 50. It's in the money, so it has intrinsic value, and it has, the remainder is time value. If you're exactly at the current price, which is really tough to do, we just saw with Zoom, I don't even think they had a $77 option strike, so we couldn't even do $77. We could do 80 or 75. It's not exactly at the money, so it's hard to get exactly at the money, but that would be at the money. All right, so where we're going to go from here is we're going to do basic calls and puts, and then we're going to do several strategies. So the strategies on the exam we're going to do are a protected put, a covered call, a straddle or strangle, and a collar. A protected put, there's only one option there: buy the stock, buy the put. A covered call, there's only one option there: buy the stock and sell the call. A straddle, we could either go long to straddle or short to straddle. So in the exam, I could go either direction. A collar, we're only going to do collar one direction. We can go long to collar. We can't do spread. So we're going to look through these and practice them some and get better at it. But the real key to understanding this part is this formula right here. Max S minus X comma 0 minus the call for a call. Max X minus S comma 0 for the put. What do you notice is the difference in these two formulas? For the call, you start with the stock price and subtract the strike. For the put, you start with the strike, subtract the stock price, but everything else is the same. Put in your notes that this first part right here, max S minus X comma 0, that is the intrinsic value. Max X minus S comma 0, that is the intrinsic value. Intrinsic value can't be negative. So we saw before remember the 100 and 135 I did in that example. 100 was the stock. So you do the max of 100 minus 135 and 0. What's the max of that? It's 0. So the intrinsic value was 0. For the put, remember we did a strike of 60 and a stock of 50. So the max of 60 minus 50 comma 0, that's going to be 10. So the intrinsic value for the put was 10 on that example. Now this whole thing is not the intrinsic value. The intrinsic value is not the call, just this first part, not the minus C, not the minus P, but that is the intrinsic value for an option. So if it's out of the money, you're going to get a negative number, so the max is going to be 0. If it's in the money, you'll get a number. So really cool. So before we do this, I want to talk about something that I think is really, really cool, which is put call parity. So there's all kinds of combinations we can do, but put call parity is one of my favorite theories. I don't even know if it's a theory, it's a truism. So have y'all heard of put call parity before? It's a really cool thing. You might YouTube that one just to see someone work. I'd love to show you put call parity, but it's really hard to do because I have to find an option that's right at the money. So I got to find a stock that's trading for 80 bucks and has an option for 80 bucks. That's about the only way I can show you how to do it. But what it says, this is a truism. If you're at the money, a call plus a bond. What is this PVX? What the PVX means is you buy a bond today that will mature exactly at the strike price of the option. That's what PVX is. That has to be exactly the same as buying a put and the stock. These two have to be equivalent. A call plus a bond must equal a put plus a stock. They have to be mathematically the same. So if this over here was $27 and this was $25, you would buy this for 25 and short that for 27. You would have sure 100% gain no matter what. At expiration, the two would have to be equal. So you get $2 a day for something you know in 3 months it's going to be worth exactly the same. They're going to be both the exact same price. How much would you do of that? I'd do a few $1 trillion of that. Why not? How often does that exist? Never. So this truism, because if this wasn't the case at expiration, you would for sure have a gain. So you can substitute bond. Now you can move these around. That means a call is nothing more than buying a put, buying the stock, and shorting the bond. That's the exact same thing. So if this was $3 and this added up to $3.40, you would sell that for $3.40, buy that for $3, and you would have for sure a gain. You'd do millions of shares of that. You would have a gain locked in. You would have no risk whatsoever. A stock, this is kind of interesting. A stock is the same as selling a put, buying a call, and buying the bond. If you did this for Zoom, and it costs $78, this was $78, and this was $77, you would sell all of that for $78, buy Zoom for $77, you would for sure have a gain with no risk. Do people do this? Yeah, people are probably checking this all the time to see if there's an opportunity out there to trade. 2008, there may have been some opportunities if you could have gotten it executed fast enough. Every once in a while markets, but there's hedge funds that watch this. Hedge funds are watching this for just pennies, not dollars, for just pennies. And they've got to execute it so efficiently they can pick up those pennies. And even then, there's limited how much they can do. You might see it written like this: C plus DX equals P times S. I mean, DK, there's your strike. So here I use the X, but it's the strike. So yeah, that's essentially the bond. So very, very famous formula. And Wikipedia does an exceptional job on this. So you might even go. I don't know why it's put call parity, not call put parity, but this look familiar? C plus DK equals P plus S. And they go into quite a bit of discussion about it, implications. And then wonderful thing is they've got links all over the place. Yeah, even Khan, y'all know him, right? Khan Academy, he has probably a whole video on this, or he has 20 videos of 3 minutes each on this, whatever he does. So it's an important concept in finance. One thing you'll see with put call parity is this concept of replication. Have you heard of replication? I'm giving you all the terms today, right? Some of my favorite terms. Anyone heard replication? So, synthetic replication. There's a phrase. Bring that up in an interview and they'll be really impressed. What is synthetic replication? Well, you can't buy this stock for some reason. So instead of buying this stock, you're going to replicate it. How are you going to replicate it? You replicate it by selling a put, buying a call, and entering a bond. That's called replication. So put call parity is a way you can replicate something. So if you can't buy the stock, but you can do all the rest of this, then you can essentially replicate the stock with these other things. There's a lot of replications out there. I can't buy X, but I can buy A, B, and C, or I can short A, buy B, buy C. A, B, and C are exactly the same as X. So instead of doing X, I'll do A, B, C. I'll replicate the security by doing that. So it's, yeah, replication is gotten pretty crazy in finance the last several years, last several decades. So what is synthetic replication? Synthetic just means I'm going to artificially create this security by doing these derivatives. All right. So let's Only got 15 minutes. So let's do some simple ones. Let's start with a call option. Any stock you want me to try? Anybody fall? And what are y'all doing for papers 3 and 4? You probably have that paper already written, right? What stock are you doing? Yeah, I don't have one yet. All right, we had Zoom, so let's do Zoom. So let's get the current price. Let's get the option maturity, the option strike, and the option premium. So here's the options. We'll go out to, yeah, March 2023. The current price, 77.15. I'm just gonna say, well, let's just say 77 just to make it simple for us. All right, so we're gonna do a call option. We're gonna go out of the money. Let's go with 80 bucks. Now, how much would that cost us? We got several columns here. Last price, bid, and ask. You notice the bid is lower than the ask. So just use your cynicism. You're buying something. Do you think you're going to buy it at the lower price or at the higher price? You're pretty sure you're going to do what? The higher price. So you're going to buy it at the ask or buy it at the bid? You're going to buy it at the ask. So you have to know this on the exam. So an $80 option is 49 cents. That seems awfully low for March 2023. Wow, that seems, wow, I'm going to go out and buy some Zoom options. I really don't believe that's can be correct. March 2017, did it update it? That sounds like a November option. Let me update it. Does that seem more realistic? $9.80. Yeah, I was about to cancel class and go buy $1 million worth of. So $9.80. Now think about it. You have the right to buy the stock for 80 bucks. It's currently trading for 77. So is it in the money or out of the money? So out of the money. So how much is the intrinsic value? 0. So what's the time value? 980s. Real simple. Okay. So what we're going to do is, let's say at expiration, let's say Zoom's trading for $50. Let's say they're trading for $55. All right, I'm going to start even lower, 30 bucks. All right. What is your gain on Zoom? Well, that's pretty easy. If you bought it today, you would have paid $77. But right now it's worth 30 bucks. So you have 30 bucks minus $77. You would have lost $47. That's kind of sad. And then it's just a straight line up. Once you get up to 75 bucks, you're only down 2, and then you start gaining. Just a straight line. Very, very simple. Now let's do the gain on the call. Remember, here we're talking about the intrinsic value minus the call premium. Remember, the intrinsic value is a max. Remember, is it S minus X or X minus S for the call? S, yeah, S minus X. For a put, it'd be X minus S. I should use K because it doesn't sound as much like S as X does. So that's our intrinsic value, and then minus the call premium, which is $9.80. So we can put that right into Excel, equal max the stock price minus the strike with 0. What's that going to give me? You're going to execute this option if the stock's trading for 30 bucks. Someone's hoping you do, but it'd be really crazy to do that. Why would you buy a stock for 80 bucks when you can buy it for 30? So that's going to be 0. But then we paid $9.80 to get that. All right, before I copy this, well, I'm going to copy down, but when is this going to go positive? What if the stock's trading for 82 bucks? What's going to happen? I'll execute the option. I'll buy the stock for 80 bucks. I can turn around and sell it for 82. So I'll make $2, but did I make money or not? How much did I pay to make that $2? $9.80. So what would my gain be? I would have lost $7. So at 82 or 85, what would happen at 85? I would have lost how much at 85? $4.80. If we go down to 85, $4.80. When do we start making, when's exactly I start making money? Stock price has to get to what before I start making a penny? So close, you're adding it to the wrong number. You added it to the stock price, but remember, we don't get to buy it at 77, we get to buy it at 80. So where do we break even? 89.80. So if we do 89.80, I'm exactly broke even. Okay. So let's graph these. I'm going to have to go further out into the future here. I mean, you're further out. So let's insert a graph. All right, so here you see this very famous hockey stick look of a call option. The orange is the call option. The blue is the stock option, is the stock itself. The stock is just a straight line. So the nice thing about the call is the most you can lose is that call premium. So the most you can lose is $9.80. You can't lose any more than that. And you see that in the graph, don't you? 980 is the most you can lose. But the stock keeps going down. Now you might say, well, on the upside, I don't make as much money, but remember, to get this upside, you had to spend $77. To get this upside, you only had to spend $9.80. So your percentage return is much, much, much higher. Your percentage loss down here is much higher too. You lost 100% here versus here, maybe you only lost 50%. So yeah, so it's much more levered, but at least you cut your loss. Once it hits 80 bucks, or well, you already started below 80 bucks, but you can't lose more than 980. Whereas if you own the stock, it keeps going down and down and down and down and down, right? So remember this, we're going to do a put option. A put option is going to be a hockey stick, but it's going to be, I don't know, left-handed or right-handed. It's going to just flip. So you'll see the hockey sticks, it's going to flip around in the other direction. All right, what did I do that y'all weren't following? Did y'all catch all of this? On the exam, you have to calculate one of these. So I might say you did this option. What is your gain if Zoom is trading at $110 expiration? That could be an exam question. So how do you do it? Remember, your gain is going to be intrinsic value minus the option premium. It's going to be max of stock minus strike, comma 0 minus the premium. It's going to equal max of 110 minus 80, comma 0. What's that going to be? $30 minus 980. So it should equal what, 2120 or something like that. 110, 2020. I can't do the math. 2020. So that's what you do on an exam. Probably 70–80% of students get that question right without any trouble. Does that seem about right? Now, some students leave this question blank. There's really no reason. I mean, this is not that hard of a formula to learn. All you got to know is for calls it's S minus X, and for puts it's X minus S. But other than that, you just plug it in there. So it's a pretty easy one. Just make sure you know that the intrinsic value is this part, because you need that intrinsic value to figure out the time value of money. The time value, the time value of the option. This one doesn't have any time values, so doesn't have any intrinsic values, so it's 100% time value at the beginning. Questions on that? So this is a stock that was down 4%. What do you think call options did today on Zoom stock? The stock fell. Is a call a bullish or a bearish strategy? You buy a call option, are you bullish or bearish? You're bullish, aren't you? You're hoping the stock goes up, but the stock fell. So what do you think call options did today? They fell. Well, you can forget that one because it probably happened early in the day. But look, 18%, 27%. So what's that delta? Like 6 times, right? So the options fell a bunch. Why didn't that fall? So this is one thing I've learned at UTSA is these percentages are based on last price. And the problem with last price, look at that last price, 290. It's radically different than the bid ask. I don't know when that last trade happened. So I remember at UTSA, I had a mutual fund with options in it. And I looked at the NAV at the end of the day, and I was like, there's no way that's right. There's some error. But they were using last price. With last price is 290, but the option's really worth $1.45. You can get really wrong answers. So that last price here doesn't make a lot of sense because it looks like there were a lot of trades today. So it may have happened early in the morning. Maybe the stock was up early in the morning or something. One person did a bunch of trades. So we changed on the mutual funds, instead of using last price, which is what they use for everything else. But for options, they started using ending. They did the midpoint between bid and ask, and that gave us a lot better nuts. So you gotta be careful. Some of these options, like there's only one trade on that day, and you don't know when in the day it happened. So look at that. The last price was 26, but the option bid ask closed at 29. So 29 would be a much, much better. And I recommend you do this for your own portfolio. If you have options in your portfolio, don't price it on the last price, price it on the closing bid ask, the midpoint of that. Otherwise, you can get some really bad answers. All right, so next class we'll do, after Thanksgiving, we'll do some put options. And then next class, we'll do the team question on relative value. All right, so we're almost, y'all see we've almost done the entire exam as team questions. So everybody should make 100 on the exam. All right, I'll stop it there. Have a good Thanksgiving.